capital market. The market may have a broad range of listed companies and significant market capitalization, but its true strength is reflected in how efficiently investors can buy and sell securities, how competitive the bid offer spreads are, how effectively prices reflect available information, and how confidently investors can enter or exit positions. This is why today's conversation is particularly important. We currently have a combined market capitalization of 157 billion US dollars. On our equities market is 115 billion dollars. Our fixed income market is 41 billion dollars, and our ETF it's 46 million dollars. The equities daily average value of trades year to date, it's $30 million. And the equities turnover year to date is 4.7 billion US dollars. We do have eight designated market makers, and these are APT Securities, ARM Securities Limited, Chapel Hill Denham Securities, Codro Securities Limited, Fair Securities Stockbrokers, Patian Securities Limited, Stanbic IBTC Stockbrokers, and United Capital Securities. Also, we have a well-established securities lending framework in place in our market. Market making and securities lending are not simply technical market mechanisms. They are critical components of a modern market infrastructure. Market makers play a vital role by providing continuous two-way prices, supporting orderly trading, improving price discovery, and helping to reduce the cost of transactions. By committing capital and taking on inventory, market risk, market makers provide liquidity precisely when other market participants may be unwilling or unable to do so. Securities lending, on the other hand, expands the range of securities as well as strategies available to investors. It facilitates short selling. Unfortunately, we do not have naked short selling in our market, which is why it's very important to have the framework that encourages securities lending and also supports market making, improves settlement efficiency, and enables investors to deploy securities that might otherwise remain idle. A well-functioning securities lending market can therefore contribute significantly to market depth, price efficiency, and overall trading activity. The relationship between the two is particularly important. You cannot fully unlock the benefits of market making without considering the availability and efficient mobilization of securities. Likewise, a vibrant securities lending market is more valuable when it operates within an active and liquid trading environment. For emerging and developing capital markets, including markets across Africa, these mechanisms have an even greater strategic significance. As we work on increasing the number of listed securities, it is equally important that we focus on the quality and depth of liquidity available to investors. This requires collaboration across the entire ecosystem, which will include exchanges, regulators, brokers, market makers, custodians, institutional investors, asset managers, and other market participants. We must also address the practical issues that can constrain liquidity, availability of securities, borrowing costs, market infrastructure, regulatory frameworks, transparency, risk management, and investor participation. Ultimately, our objective is to build a market that is deeper, more efficient, more resilient, and more attractive to both domestic and international investors. Today's webinar provides an excellent platform to exchange experiences, examine what has worked in other markets, identify the challenges within our own market, and most importantly, consider practical steps for unlocking greater liquidity in the equities market. We therefore encourage everyone participating today to engage actively in the discussion. The success of our capital markets depends not only on the institutions that operate within them, but on our collective willingness to innovate, collaborate, and continuously improve. Let me thank our speakers, our panelists, our partners, IBTC, Stanbic IBTC, and the chairman of Association of Dealing Houses of Nigeria Action, Mr. Shende Adenigbe, and the president of Chartered Institute of Stockbrokers in Nigeria, CIS, Dr. Fiona Ahime, and other participants for being part of this important conversation. We look forward to a very insightful and impactful discussion. Thank you, and once again, welcome to today's webinar/workshop.
Thank you so much, Jude, for that insightful opening remarks. In case you missed it, that was Jude Chiemeka, the CEO of the Nigerian Exchange Limited. Like he has mentioned, and welcomed you to this very interactive, I would say, yes, because you'll be dropping your questions and practical training. We're going to cover things like market makers' obligations and compliance expectations. You're going to hear about how to leverage securities lending for equity market making. Then you're also going to hear from the experts on roles of the security lending in liquidity provision from the agent's perspective. Then you're going to have a workflow, operational workflow and trading systems, right? The roles of securities lending in liquidity provision. So you're going to have that workflow walk through on this, so that you've heard it, you've understood it, now you see it. That's how practical this session is going to be. This one-day training will be. Again, I remind you, please drop your questions in the Q&A, because we will take the questions after all the speakers have spoken. Yes, that is to make sure that you understand everything. Because of how big the class is, unfortunately, will not be taking up raised hands. So put that question, whatever it is, in the Q&A, and we will take it. So to start off this session, this training will be our very first session on overview of market making, the framework. And that will be taken by Temitope Osunde, who is the team lead, equities-based products and derivatives in the Nigerian Exchange, from Nigerian Exchange Limited. Temitope, are you here?
Yes, I can hear you. Good morning.
Fantastic. Please go ahead.
Thank you very much. Please confirm you can see my screen.
Yes, I can.
Thank you. Good morning, everyone, and thank you once again for joining us. Over the next few minutes, I will just be providing a high-level overview of the NGX equity market making program and why it matters in the context of today's equities market, how the framework is structured, and the opportunity for trading license holders to play a more active role in strengthening liquidity on the NGX. I would deliberately stay at framework level, and because the detailed obligation and compliance requirements, as well as the trading or practical operational workflow, will be discussed subsequently in the session. So today my focus is very simple. It's to speak about the market opportunity, the overview of market making, how the NGX market making program architecture works, and the call to action for market makers. Before we start, I would just like to give a broader market context. As we can see on the screen, as at yesterday, NGX ASI stood at approximately 242,454 points and representing a year-to-date return of about 56%. And the equity market cap was approximately over 156 trillion naira, with a year-to-date market turnover standing at 6.33 trillion and an average daily turnover of over $30 million. And these figures just It demonstrates the scale and momentum of the NGX market, but an important distinction is, I would say, the growing market does not necessarily translate to automatic uniform liquidity in the market. And as we can also see on the pie chart here, the trading activity has been concentrated on selected sectors, particularly the financial services sector, which took up to 50% of the year-to-date market activity, and that concentration just creates a clear market development opportunity, I would say, to translate this overall market growth into a more consistent order book depth and tradability over a wide range of securities across various sectors. And I would say this is where market making is important. This is where the liquidity opportunity sits. By maintaining a credible two-way interest in designated securities, market makers help to support that tighter spread, I would say, a stronger price discovery and a deeper visibility of visible liquidity and better execution conditions for investors, which drives confidence and consistency and consistent participation as well. And the opportunity here is not just to grow in market size, I would say, but to make the growth increasingly liquid, accessible, and investable. Moving on to the next slide. Before I dive into the NGX market making program specifically, it would be useful to just create some sort of background or briefly establish what market making is and why it matters. And in simple terms, market makers are market participants that provide orderly trading by standing ready to buy or sell securities through a firm two-way quote. And what they do is to provide both the bid and offer price to allow investors to transact without necessarily having to wait for a natural counterparty to emerge. And a broad benefit of this is a more, I would say, efficient market, resilient markets that support a tighter spread, like I said earlier, a deeper order book, better price discovery in the market, and improved execution. Collectively, all of these outcomes can help to strengthen investor confidence and encourage broader market participation. And this just provides the context for the next slide, which narrows down to NGX market making program and how it works. And at high level, the program can be, the framework can be understood through, I would say, 5 pillars. First is the eligibility and approval. This is where interested trading license holders would express their interest in participating as market makers through writing to the NGX, and this application is reviewed against the capability, resources, and requirements that they need to perform their role. And second block here, I would say, is upon approval of being a market maker, market makers are obliged to select securities across and provide liquidity coverage across the liquidity classification stipulated by NGX under the liquid, less liquid, and illiquid security. And this would help to extend market making activities beyond most active traded securities or sectors in the market, thereby providing liquidity across various securities. Third, I would say, is the core liquidity function. This is where market makers place both bid and offer prices in the market, speaking about the percentage time in market of 75%, the minimum quote size across the various price band, and also the spread width across the liquidity classification, with liquid securities having a spread width of 3%, less liquid 5%, and illiquid securities have no specified threshold. And the illustration just shows the concept of what market making is in action, where there's the buy interest on one side, there's a sell interest on one side, and a transparent spread between both bid and best bid and best offer. And the objective is just to maintain a credible quoting within the parameters that have been stated in the program. And fourth here is the compliance and reporting. And this program is supported by monitoring to ensure that participation is meaningful and it is within the confinement of keeping the integrity of the market. And the last one I would say is incentives. Market making requires a lot of capital commitment and ongoing liquidity provision. And so the framework provides incentives to support participation, inventory, flexible inventory management, transaction fees, waivers, and just sustained performance and boosting the brand equity of market makers that are participating using the leadership board as well. And I will not go detail into the threshold. This will, like I said, will be covered subsequently. But looking at the market making activity on NGX, we currently have 8 market makers, just like the CEO had mentioned. And from 2012 to date, these are the transaction size and volume and value for both the sell and buy side. Moving on to unlocking the next phase, I would say this is the most important slide, and this is where the call for action lies. And the framework provides the structure, and the priority here is to convert the structure to more active market making or broader security coverage, I would say, which would bring the meaningful liquidity outcome that we seek in our market. And the call here is for trading license holders to register. I would say codes provide and build, register to participate as market makers in the market, positioning it as a core liquidity activity, and to participate through translating into a credible, competitive, and consistent two-way interest in the market, and provide the use that participation to a deepen order book liquidity and improving tradability in the market, and build a collectively stronger, I would say, market making activity that can help boost investor confidence, strengthen the overall quality, depth, and resilience of the market. So the progress we want is simple, is to see more active market makers, a broader coverage in the market, and deeper liquidity. And importantly, success is not necessarily measured simply by the number of registration, number of listings, measured by the quality, the resilience, the consistency, and the executability of liquidity available to investors. So in closing, I would say that the NGX market has significant scale, as we've seen, and momentum, as we've seen on the slide. And the opportunity here is to drive that growth into a deeper, broader, and more resilient liquidity. And the objective is a market that is not only larger, but more liquid, more efficient, and more investable. Thank you very much.
Thank you, Temitope, for that. And Temitope spoke on market maker, an overview of market making framework. And in that framework, she had talked about the 5 areas, which included eligibility and approval, talked about security selection. She also mentioned liquidity obligations, went on to speak on compliance and reporting, and then finally on incentiveness, if I am correct. Then she gave out a call for action where she said 4 of them: register, quotes, provide, and build. So thank you, Temitope. And to go on, my name is Ugochi Obi, the head of the X Academy, which is the learning arm of the exchange. I thought to mention that since everybody knows everybody. But we go on next to the market makers' obligations and compliance expectations. But before then, I see the questions coming in. Please let them keep coming in. Keep dropping your questions in the Q&A, and we will take it. As has mentioned, I see some questions on if the training will be recording of the training will be sent, or the slides. But we've done a lot better. Is as we speak, it is being streamed live on YouTube. So after the training, you can go back there and watch it as many times as you want. That's how much we appreciate you and want to make sure that the knowledge is there for you, available to you all the time. So with that, I'd like to call on Oluwafunbi Abata, the team lead, regulatory developments and approvals for the market regulation, NGX Regulation Limited, to speak to you on the market makers' obligations and their compliance expectations. Funbi, how has your day been thus far?
Very well, thank you. Good morning.
Thank you.
And good morning to our participants. Please confirm that you can hear me and you can see my screen at this time. Hello?
Yes, we can see your
All
screen.
right. Thank you. All right, so I think it was a very wonderful overview by my colleague Temi Tokwe, and I'm just going to take you through what to expect of market makers, also starting with some historical background, right, around the market making regime, move on to responding to the call for action. What does that look like for trading license holders who are yet to be market makers? How do you go about it? And once you know you have been approved to perform that registered participant function, going on to your post accreditation compliance obligations. So very quickly, because of our time, a lot has been said about, from the overview, in terms of what market makers do, in terms of supplying, liquidity and efficiency to providing the two-way quotes on securities on the obligations, that is, the securities that they select in their basket. The Equities Market Making Program was initially introduced in 2012 and was later revamped in 2021, giving some feedback from stakeholders. And I think the objective really was to ensure that the new framework, offered some level of flexibility and incentive in order to encourage more participation in the program, right? So what are the things that we observed in the initial framework that needed to change? Weak incentives, high personnel costs, cost of technology and limited funding options, and so on and so forth. So the goal with the revamp was to ensure that those issues are addressed, and we'll highlight some of those changes, notable regulatory changes in the next slide. So, going forward to where we were and what we currently are at the time, for the securities in your basket, the exchange would allocate securities to primary market makers. But currently, under the amended regulatory framework, the exchange registers market making firms as trading license holders who are interested in participating in the program apply, and then they get to select on application 3 securities, all the securities that they want, to perform their obligation to the market making obligation for. There's also preference for listed companies to elect registered market makers. So for listed companies, they can also choose market makers that have already been registered with the exchange to perform that function. Under the current regulatory framework as well, there are no limits to the listed securities that you can have in your basket, limited to 10, and secondary market makers didn't have any, because the old secondary primary market maker framework has been expunged, and it's just market makers that we have now under the Equities Market Making Program. You can select your securities across, but also you have a minimum selection requirement, and I'll also touch on that in the following slides. Another point to note would be the personnel requirement. Again, like I said, the new framework offers flexibility around high costs. Also addressing issues around high cost of personnel, because initially, for every product that you are going to be market making for as a primary market maker or secondary, you would have to have a unique trader for each of these products. But now you can have one trader across the multiple products on the exchange. Therefore, trading fees, some of it are this has been also highlighted as one of the incentives when Temi gave the overview, right? So before, there used to be like a rebate arrangement where you sort of communicate to the exchange what what those costs are, and then a portion of it is then given back. But now those transaction costs have been waived to allow again or encourage participation in this program. In addition to this, I think one other notable amendment would be introduction of the market making guidelines, in addition to the amendment of the Chapter 8 of the market making as the rules, Chapter 8 of the rules, which provides for market making. Again, having a very lean framework that allows or encourages participation, and the guidelines also make it easy for interested participants in the market, trade license holders, sort of understand what their regulatory obligations are. Just sort of zooming in onto those provisions to ensure that it's very practical, right, in terms of compliance. So moving very quickly, I know these numbers have been thrown around, but if you look at it, currently we have 8 registered market makers out of, as at yesterday, 188 active trading license holders. So only 4.3% of our active trading license holders are currently registered market makers. So that's that shows low participation. And then if you look at the securities that are currently under obligation under the market making program, there's about 37 of them out of about 144 listed equities, right, at this time. So that's, again, shows that there's substantial opportunity to expand market coverage, and there's need to have more trading license holders actively involved in the market making regime. And just so riding on Temitope's call to action for trading license holders who are on the call, and based on what we'll be learning today, then pick an interest. What does that look like? What do you have to do? What are the next steps for you? Or the next step for you would be to apply to the exchange to register as a market maker. There's an application form, and on the face of that application form, you are to select your mandatory securities and other additional securities that you want to be a market maker for. When we speak about the mandatory securities, market makers are expected or required under the current regulatory framework to select 3 mandatory 3 securities across each liquidity class. Remember that Temitope had referenced that the reason for this is, again, to be able to extend trading activities beyond just liquid securities. So the requirement is you pick one security in each liquidity class. That is a liquid stock, a less liquid security, and an illiquid one. What are the metrics for those? So for liquid securities, those are securities that for the tradable days in a year. So let me give an example of, let's say, a week, right? In a week you have 5 tradable days. So above that security, a security that trades over 70%, above 70% of all tradable days is one of the metrics to classify security that is liquid. Also around trading volume turnover, that is volume traded over the number of shares in security, sort of addressing that free float, right, is about 5%. And then there's the average value traded per day for that security is above 5 million. That will be classified as a liquid security. Then for less liquid is where the security trading activities recorded on that particular security between 30% to 70% of tradable days in that quarter. Also, for the volume traded over the number of shares in issue, that will be between 4.99% and 1%, and then the average value per day being between, that is less than 5 million up to getting down to 1 million. Then for illiquid, again, that's securities that don't really get enough action, that's trading activities on them. So like I said, the idea is that if you have this selection of securities across the different liquidity classes, then we're able to ensure that there's supply of the securities, and there's no concentration on maybe just liquid securities as opposed to other securities that are not as liquid as some others. So that encourages participation across board. And like I said, this thing is reviewed quarterly, and then when you apply, we do provide you again with this data so that it will inform your decision terms of the securities that you want in your basket. Also, one of the things you also have to highlight upon application is providing 2 market making contacts. One of them being the chief compliance officer, who again will serve as the point of contact for regulation to engage with respect to your market making activities, also the exchange to engage with respect to your market making activities, as the case may be. We also required to provide your audited financial statement for the last 3 years, but this is only applicable to recently licensed firms. So once you submit your application form alongside the required supporting documents, we go ahead to do something we refer to as a capital assessment, right? And what does that look like? Now, under the current, market making regime framework, the initial program had a fixed net capital requirements for primary market makers, and then secondary, I think primary was 500 million, and then secondary was 250 million. But now there's a flat floor for the net capital requirement of 200 million, or 0.02% of the free float adjusted capitalization of the securities in your basket. So what does that mean? When you select your 3 mandatory securities across the 3 liquidity classes, right? Liquid, less liquid, and illiquid. So the greater of 200 million or 0.02% of the free float adjusted capitalization of those securities would be the benchmark for your capital requirements. That is the net capital requirement you need to be able to perform your obligation for those firms. Then, if you have additional securities in your basket, that is in addition to those 3, you pick a 4th, 5th, or 6th one. There are no limits, remember, to the number of securities you can have in your basket. You also be calculating 0.02% of your FFAC, and then that will determine what the trading license holder is supposed to hold as a net liquid capital requirement. So when we then look at what that is based on your last submission, because remember that trading license holders, as part of your regulatory obligation, is to submit on a weekly basis your net liquid capital. So we take the latest one submitted by that trading license holder, compare it to what that minimum liquid capital requirement is based on the securities that the trading license holder has elected. And if the net liquid capital position of that firm is equal to or greater than what that required minimum is, then they are compliant with the capital requirement, and from there we then make for the recommendation to NGX for the appointment of that trading license holder as a market maker. So this just provides like a flow chart of what I just explained, right from the point of application, completing the application form, submitting the required documents, which reflect selected securities. We do the NLC assessment, which is the capital requirement assessment, already explained. Once that checks and you're compliant, we move on to appointment, recommendation for appointment, and then NGX, appoints that trading license holder as a market maker. Excuse me. Now, post-accreditation compliance, you've been appointed as a market maker. What are your obligations? Some of it has been spoken to already. And then what are your compliance expectations as well, which is really the crux of it. The obligations of the market maker set across in the guidelines and the rules. There are about 5 major ones that I'll be highlighting here. One of them is provision of the 2-way codes. Like we said, because they are, the obligation, the objective of the market making program is to ensure, liquidity, as availability of those securities that you have in your basket. The trading license holder who is registered as a market maker has the obligation to provide both, bid and offer prices on a continuous basis for each security in their basket. And when you do this, you are also required to keep those prices around a particular band. In terms of the spread width is also specified in the rules, and the spread width for each of securities you have in your basket is based on their liquidity classes. James highlighted in our presentation for the liquid stock, it's about 3% spread width. For the less liquid, 5%, and then for the illiquid is unspecified in the rules. There's also supposed to be market presence in terms of the securities you have in your basket. You must maintain those quotes, right? At least about 75% of every trade we did. So if you have, for example, right, 6 hours, 75% of within the trading hours, you have to make those quotes available. Then we'll talk about the minimum quote size. Again, the rules or the guidelines specify that for each of the securities in your basket, depending on the price band of those securities, there's a required minimum quote size for all the prices you're providing that the market maker must provide the market. So for the price band A, right, you have to provide 40 share units of that particular security. For securities that fall under the price band B, then you're providing about 100, I believe. And then also the rules specify for price band C as well. Then a commitment period is also stipulated under the guidelines that is once you are accredited as a registered market maker, you must perform that role for at least 6 months. So within that mandatory commitment period, you cannot voluntarily deregister, right, within that time to say, okay, you want to withdraw your registration as a market maker. Once you commit, you're accredited, you have to, lock in for about 6 months before you're able to then withdraw your registration. In terms of the operational or practical trade flow for or implementing these obligations, my colleague will speak to it in a later presentation today, so that you can sort of get a hands-on experience or feel of what this looks like in practice in terms of providing those spread limits and all of that on the trading engine. Then I think another noteworthy obligation is the disclosure requirement for registered market makers to NGX regulation, to notify NGX Reco of material changes in its operations. That is where your capital, if at any point in time your capital requirement or your capital falls below the required capital requirement for the securities in your basket, that is the net free capital position has fallen below that threshold that we spoke about, that is 200 million or 0.02% of the free float adjusted capitalization plus the 0.02% of the additional securities in your basket. So that minimum, once it falls below it, you're required to notify the exchange. If there's anything that has come to your attention around your business operation or your corporate structure, anything that you think is also or would disqualify your firm from being able to market make, you're required to notify the exchange of that material change. Again, that helps to manage risk. So for failure to perform this obligations, we initially would give a warning letter to those market makers who fall short of their obligations for more than 3 out of 6 months, and then if it's not regularized in terms of they don't start meeting those obligations again, then we would deregister such trading license holders as market makers. I think another noteworthy periodic compliance matter would be around, again, the assessment, because we want to ensure that market makers are carrying out their functions around providing liquidity to the market and ensuring that this program extends to the various liquidity classes of securities. Every half year, the exchange reviews the positions, the security selections of the registered market makers, because the assessment of the liquidity is done, like I said, on a quarterly basis, and this changes from time to time, right? So at the point where you applied, you could have had perhaps a stock you selected that was less liquid has gone on to become liquid. Then you are required to update your basket to ensure that you have that less liquid or illiquid or whatever security your the mandatory security in your basket. If anyone has changed from their initial classification, they're required to update it by selecting another security that helps you fulfill that obligation of having a selection of securities across the different liquidity classes. We also review on a quarterly basis compliance with the minimum net liquid capital requirements, which I've explained. So I think that just gives us an overview of what, in terms of compliance expectations and obligations of, registered market makers.
Indeed.
Markets. Thank you very much, Ugochi.
Yes, thank you so much, Oluwafunmi, for that. Now you've understood a bit more about the market makers, their obligations and compliance that's been expected of market makers once you have become one. And he talked about, I think 5 or 4 obligations that are quite expected: the two-way quotes, the spread limits, and the market presence, the minimum quote size, the commitment period being the last of those obligations, amongst others. Thank you, Oluwafunmi, for that. There's some questions there already for you. So I'm asking that in terms of the personnel requirements, they want a bit of clarity, but we'll take that after we have heard from, or we have listened to understand about how to, now that we've heard about the market makers and how the framework is, how do you now leverage security lending for equity market making? And we'll also, in that same space, hear about the rules of the security lending in liquidity provision from an agent's perspective. And to do that, to be 2 experts as well, we have Jesse van Resborg, and the head of the equity sales trading is from Standard Bank Group, and Hitesh Haduf, head securities lending, Standard Bank Group. Jesse and Hitesh, hello, are you here? How has your day been so far?
Good morning, everybody. Day's been well. It's been an interesting conversation so far. I'm learning as well so far. So you're never too old to learn.
Say that again, please. Okay.
So you're never too old to learn, I guess.
Exactly. I do agree with you. And that's why we have over 300 people in the room waiting to learn. Yes, we can see your screen as well.
All right. Say good morning, everybody. Let me kick off and try and catch up some time. My colleague Jess will join us shortly. He's on the trading floor, and as I know you brokers have made some time for today, he's trying to make us some money. He will join as soon as he can. I have pinged him already to join, but he is on the floor, so I do apologize. You won't be able to see his face. I will send you a nice screenshot of him later so you can have a picture to put to that face. Okay, let's kick off. So if everyone can see my screen, I'm going to kick off. I think Mr. Jude covered a lot in his introduction. So I'm going to recap to what he was saying in terms of what securities lending is and how we can play a role in the market making. Looking at the current 8 market makers and the current low volumes that's happening within market making. This is where we shine as a product. So I sit as the product head for securities lending. I'm also double hatting. In another role, I am the chairman of the South African Securities Lending Association. So globally, there are various securities lending associations that cover securities lending, securities financing. We have the International Securities Lending Association, ISLA. We have ISLA Americas that covers the Americas. We've got CASLA, which is the Canadian Association, and we've got PASLA, which is the Pan-Asian Securities Lending Association. And of recent, the associations are trying to form one in the Middle East. So you can see it's a broad. We cover the full globe of all the associations. And in the recent conference that was held in Europe from an international point of view, there was a collaboration between all the associations. All the chairmen sat on a panel to see how we grow the product and standardize the product to roll it out into new markets. Right? There's a lot of work that's been done in Nigeria to grow securities lending, and I'm going to dive straight into it. And please bear with me. So if a lot has been covered already. So if you look at market development thesis, right, securities lending is not a side market. It's part of liquidity operating system. For Nigeria, the opportunity is converting securities lending from a permitted mechanism into an actively trusted market utility. So use us to close those gaps. What do we look at? Liquidity. Borrower supply can support narrower spreads and deeper books. Market making, right? We touched on market making earlier. Reliable borrow lets market makers warehouse the risk and manage the imbalances. Then you've got settlement. Right? Initially, what security lending was about was to cover your settlement risk. So borrower availability helps to prevent and resolve delivery shortfalls. Investor return, asset owners. So there must be something for the guy that's giving us the stock. He can earn an incremental revenue with controlled risk. And controlled risk is key there. And then confidence. Transparent rules, collateral, and reporting build participation. It's all about transparency. If you look at the financial crisis, 2008, 2009, there was a lot of reforms done in securities lending. ISLA drafted the 2010 GIMSLA that we used, the Global Master Security Lending Agreement, which is the lending agreement. It's a globally recognized agreement. And a lot of the draft was done to refit and to repurpose and protect investors, borrowers, and lenders on either side for these sort of market events that we see happening. Liquidity is the foundation of market confidence. Speaking a lot about liquidity. Efficient secondary markets like securities lending help investors buy and sell quickly with lower transactional frictions and market prices for information. So you look at depth, more visible, executable interest across price levels, tighter spreads, right? Lower implicit costs for long-term and active investors, price discovery. Price incorporates both positive and negative information. And then resilience. Liquidity providers can keep quoting through ordinary imbalances. Let's look at the building blocks, right? The next task is to activate at scale. So Nigeria has rules, as they mentioned. They've got the market-making structures, which we've just seen. They've got the securities lending guidelines. They've got settlement harmonization, one of the first countries in Africa to go live with T+1. So firstly, well done to you guys. And South Africa is taking a page out of your book. So with that, you see growing institutional investor opportunities. The exchange and market makers, the NGX permits the market making programs, appoints trading licenses, as we said, and post-trade monetization. SEC has announced T+1 since 1st of June. And then we've got securities lending and short selling. The NGX permits covered short selling when securities are borrowed and are in the seller's account. Naked short selling is banned. Right? You cannot naked short sell. You cannot sell something you don't have. You have to make sure you've got the borrow in place. Right? And then you've got institutional supply. And this is recent. PENCOM framework permits PFAs to lend eligible securities. So they're providing us now with that liquidities as we roll out and we get the PFAs on board. 25% of what they're able to, from an eligibility point of view, is unlocked into that liquidity pool. And that's what's going to help us grow this market. Right? So let's look at the life cycle. A simple life cycle: lend, collateralize, use, and return. Right? So you got the beneficial owners. They authorize the lending and eligibility of assets. Then you've got securities, the transfer of the loans from the lender to the borrower. The borrower has to put up collateral. There's protection. It's a collateralized loan. Right? We've got haircuts in place. SEC permits, I think it's 20%, 25%, and 30%, if I'm not mistaken, on the different asset classes. And Digi may be able to tell a bit more a little bit later on the haircuts. So it's haircutted. It's protection for the investors in terms of market movements. Then you've got the use case. So the borrower supports settlement, market making, hedging, and short sales, covered short sales, I say. And then what happens at the end of it? When you're ready, you return the equivalent securities, corporate actions and fees, and collateral is reconciled. You receive your interest if you place cash. So what is it? It's practical discipline. We have daily mark-to-market to ensure that the exposures are managed. We've got enforceable collateral so that in the event of default, you're able to unwind that collateral to put the investor back in the same position. We have clear recall rights. Right? So the lender has the rights to recall. You have the right to recall your assets you place as collateral. And you get same-day confirmations. As we book out the loans, you get a confirmation, which you're able to provide to the exchange that you've got cover in place as you've traded your short. Market makers quote better when inventory risk is managed. Right? So look at this, right? We've got borrower supply, right? The agents provide the assets to the agent lenders provide the assets into the pool. The market makers are able to then have two-side quotes and maintain less settlement fears. The order book quality, so the spreads, depth, and immediacy improves. And what does it result in? Lower friction and better entry and exit confidence. Right? A policy point. Covered short selling is an infrastructure for liquidity. Naked short selling is not. What security lending contributes to market quality? Right? The strongest case is not more shorting. It's better liquidity and more complete price discovery and smoother settlement. If we look at some research across what's happening, if you look at liquidity, BIS research found the shutdown of one of the major lending programs reduced liquidity in affected corporate bonds. Price discovery. Federal Reserve research links stable lendable supply to higher shorting information, higher demand, and improved information efficiencies around negative earning news. Right, so the ability to soften that blow when market news has come on. Settlement efficiency. Settlement fails are often driven by insufficient securities. Right? Borrowing can get settlement chains moving. So unclog that wheel. Adding a securities lending trade helps the flow. Market making. ISCO identifies liquidity provisions as a vital to price discovery and fair and efficient markets. Liquidity tools must be paired with strong guardrails. Locate, borrower discipline, collateral, transparency, and closeout processes. We have the agreement I spoke about, the Global Master Security Lending Agreement. That's standard. It provides the protection. Right? So let's look at practical benchmarking. Right? So this slide here looks at South Africa from an example. And this is provided by DataLand, which is a global data provider. So what it looks like? We have the association. The association drives standardization within South Africa. Together with ISLA, which is the International Association, the two associations are looking to expand into Africa to help standardize and grow the product as we see demand. Nigeria themselves have established security lending programs. Kenya is looking at established and improving the security lending program. Other markets, Mauritius, Ghana, Uganda, Botswana, Namibia, once they go into DMAT, are looking at the same thing. So why not lend our expertise to guide to drive a standardization? Yes, every market is different. We're not saying it's a copy-paste. There are nuances in each market, and the agreements cater for those nuances. You have schedules that cater for, we want to call it localized nuances and legislations that protect the local investors, but what that also provides the international investors comfort to say they are protected. So let's look at these stats. 1.6 trillion rands worth of assets are available currently at the end of July in the South African market. That's available for lending. We currently have 143 billion rand of those assets out on loan, right, across various desks. That roughly translates around as 8.79% utilization of those lendable assets, right? And that translates to a fee almost around 31 basis points, right? So what happens is, as you add more security, so initially, this is the supply and demand, guys. I'm talking to you guys, this is your bread and butter. Lack of supply drives prices up. So current levels and spreads on securities lending will be a bit higher. As more and more guys come into the market and more supply and more liquidity is created, that price comes down. Right? It's a natural attrition. We started in SA, I'd say about 20 years ago, with an average fee of around 2.5%. We're currently sitting around 31 basis points. So over time, it comes down as you have more supply. Right? What are the lessons for Nigeria? Build trust through visible industry forums. This is an example of it. Right? Common documentation. We've got the Global Master Securities Lending Agreement. It's a common documentation. Right? Data transparency. We provide all the data to SEC in terms of what we're doing and to the exchange. And then collateral modernization. Right? As we see in the collateral modernization, it's evolving very quickly. We've got stable coins, digital assets. These are all things that are coming into the picture. And like we need to catch up first with doing the normal work, but you're seeing the world evolving where, for instance, a stable coin can clear real time 24/7. Right? You're able to put up your margin collateral calls on a weekend if you see you're at risk. You know? In intraday risk, you can settle a stable coin as an example. And this is a use case that some of the international associations are looking at. if you have intraday risk between you and your client, one of the mechanisms is an example is a stable coin that can settle real time. So those are new modernizations that we're seeing in the collateral world. And I believe the Nigeria market is at the forefront where they don't have legacy issues to deal with. They can speed up and implement these new products that are coming out. And then let's look at some common patterns. Enable liquidity, constrain abuse, and professionalize post-trade. So if you look at the world in terms of all these different markets, in the US, they're all around the same, right? But just different themes. So, the themes are constant. US SHO uses market making, locate, and closeout requirements to bona fide market making exceptions are limited. The European Union short selling regulation bans uncovered shorts. Naked short selling is not allowed, right? On shares and sovereign debt. Significant net short positions are also reported and disclosed. They've got SFTR, right? Securities Financing Transaction Reporting. B3 in Brazil supports short selling and states that regulators recognize short selling benefits price and liquidity. In India, the SEBI introduced short selling alongside with a full security lending borrowing program to enable settlement of securities of short sold securities. And then on the global scale, ISLA reported the global security lending revenue for 2025 neared $15 billion across the globe. That is a lot of money we're leaving on the table, guys. It's a lot of money. The spreads are small, but that's a large number. And yes, bulk of it is coming from the established markets like the US, UK, and Europe, but the smaller guys are also coming in. Right? I think if we looked at SA's revenue, it touched on just under R1 billion, if I'm not mistaken. It's still quite a bit of money. And then the agent lender, which is the desk that's going to provide you with the securities. We see ourselves as the trust engine. Right? The job is to monetize idle assets for asset managers, for pension funds and insurance funds, without compromising asset owner governance and risk appetite and market integrity. There's a bit of responsibility that comes from an agent desk. We can't just provide securities into the market if we are unable to manage the recall risk, the liquidity constraints that's attached to that. So as I walk through a few pillars here, you see we've got written authority of eligible assets that you can borrow, right? Approved collateral that comes in. Then you've got counterparty controls. Each counterparty we onboard, the agent onboards, goes through a credit assessment, provides, although it's collateralized facility from a loan point of view, you still have limits that you have to attach to a client in terms of your risk appetite to that client. There's onboarding and ongoing monitoring of your counterpart daily. Then we look at the collateral discipline. Daily marking happens. Margins and haircuts are called, collateral are segregated, and we're able to enforce and substitute if need be, right? So collateral, you put the shares in or you put the cash in, it can move daily, right? Prices move. You can recall your collateral. You have to top up your collateral. That's where the substitution is key. Life cycle controls. We talk about same-day controls, recalls, corporate actions, manufactured income. We're quite fortunate that the regulators have recognized now that the manufactured dividend or coupon that is paid over is now doesn't carry any stamp duties, right, or tax. And then fails management. That is the core of it. At the end of the day, making sure your sales settle. With that comes transparency, client reporting, revenue splits, audit trails, and governance committees. It's quite key. Right? If all of this is in place, you're running a good show. Okay. From permitted activity to scalable market utility. Right? The upsides come from activating institutional supply, improving borrower reliability, and connecting lenders to market quality objectives. Right? So, institutional yield. They got to be in for some money. Right? Pension funds can earn incremental income on lazy assets. Right? Market makers, and that's what we're here for. We can supply that positions to allow you to provide the short selling on the market making. Right? So it's just not just the buy side. You can do the sell side as well, because you now have that availability to do that. Settlement discipline. Borrowers can resolve shortfalls in the T+1 environment. Right? With your short to the market settlement cycle, we can help you get your stock across, because there's delays, there's always issues. Stock might be use us to help grease those wheels. Market data flywheel. Regular reporting allows regulators, so we report exchanges and regulators to see, to track utilization, to check the fees, check the fails, and check the liquidity impacts, right? And then lastly, it's foreign investor confidence. Transparent securities lending reduces friction for hedging and index activity, as well as liquidity provisions. Trust grows when friction points are dealt with openly. So forums that are created helps you provide this trust. The market scales only when legal certainty, operations, and incentives line up. Legal tax certainty, so clear treatment of title transfer, netting, insolvency, manufactured payments, and duties. That's been done. A lot of work has been done on it. Operational readiness, straight-through processing, settlement cut-off times, recalls, partials, and exception management. We're working through it. We're getting there. Education and conduct, sessions like these, right? Clear distinction between covered short selling and abusive naked short selling. Collateral usability, right? Eligible collateral must match the risk appetite, supporting scale and reuse, right? It has to match the risk appetite. And I think we're heading in the right direction in terms of what's allowed and the haircuts that's there. Over time, I suspect maybe those haircuts would come down, but for now, it's within the risk appetites. Data transparency, regular public reporting on lendable, on loan utilization, fails, and concentration risk. The stats I provided you earlier from South Africa is publicly available on SASLA's website in terms of what the market size is, what the average fees are, and what's out of loan. And it's public information. And then participation economics, fee incentives, market maker obligations, and asset owner risk return must be balanced, right? You have to balance it. You can't just flood the market to make a quick buck. You've got to balance it. You've got to take responsibility. And then let's look at the phased approach, what I have as a phased approach for the Nigerian market. Phase one, confidence. We've got that already in the bag. Standardized documents, moral approvals, reporting templates, and educations for asset owners. We're doing that. Pilot liquidity. Let's try and do that. Focus on a basket of liquid securities, minimum 3 as I understand. Linked to market maker commitments, and monitor the metrics. Post-trade cycles, automate the recalls, the mark-to-marks, the collateral substitution, allocations, and settlement workflows. And then you broaden the supply. We're doing that, or we've done that, right? We've activated pension funds. We're looking at the insurance and the CIS funds. Offshore participation will naturally come in once they see the activity and they can see the stability and have the trust in the market to activate, right? And then market utility, the last one. Publish market quality metrics to adjust rules and adjust rules and incentives based on the evidence. As I mentioned, as the market improves, you might see those haircuts come down. That's an example. You know? So what is success matrix? Not the number of loans, but the measurable improvement in spreads, depth, settlement quality, and investment confidence. Lastly, I would say liquidity is a shared responsibility. Sorry, I just want to make sure Jess is on the call. I can't see.
I am indeed.
Okay, cool. Last slide and then you upload. Okay. Lastly, liquidity is a shared responsibility. Not a single participant can create liquidity in the market alone. The ecosystem must connect supply, demand, rules, and trust all together. The regulators enable activity and enforce market conduct. The exchange, the NGX, and the CSDs set programs to publish data and automate post-trade. Asset owners provide the inventory. And agent lenders operate within controls, transparency, and fiduciary discipline. Lastly, you've got the market makers and the brokers that are able to provide liquidity, two-way liquidity, and manage settlement obligations. So what is the call to action from my side? Make security lending transparent, risk management, liquidity, utility for Nigeria's next step of capital market growth. And with that, I'm going to hand over to Jess to talk a little bit about how my world fits into his world. Jess, over to you.
Good afternoon, guys, and thank you, Atish, for the in-depth rundown of the landscape and the world that we are looking at. I think it's worth just having a look as to how this feeds into our world, guys, which is the broking, market making, and trading side of things. Now, I've narrowed this down into 3 pillars which I wanna look at, but I think it's also worth touching on why this is so key. And to Tish's first point that he made, stock lending or borrowing isn't an administration function. This is a key pillar that keeps the trading desk going. We provide and maintain liquidity. How we do this is through facilitation, and I'll touch on those two pillars shortly. But that's this short selling capability, and it does not just sit in the market making function. Hedging derivatives and just improving the overall price discovery or efficiency is key. Now, what gives us more insight and color as well away from the client-facing side is the ability for a proprietary desk or a trading desk itself, be it sitting under a bank, be it sitting under a broker that has balance sheet, is of course to take advantage of price movements and going short several stocks, given whatever view this might be, and being able to facilitate that and monetizing those trades. But let's touch on the client facilitation first. Simple. Providing liquidity to clients. We've got a trading desk going out of the market making seller of, let's look at a stock like Zenith Bank. We will short sell a Zenith position, given our view on the bank. Let's say we think earnings are going to miss, stock done too much. We are happy to put a short position on the book because we are running Access Bank against this, or we are happy to run a short in Zenith alone. Market maker, client comes on to us, we are happy to buy 5 million Zenith off you. Our desk will chat directly to Hitish's world and go, guys, please source 5 million shares of Zenith, and the trade is on the book. Client borrowing and sourcing. This is a very interesting one because, as I've said, Hitish's desk is not just an administration desk. They'll have relationships throughout the market as well, speaking to institutional clients directly. We'll have a trade that's been put on away from us, where a client's gone short. Let's use Zenith again. Clients shorted Zenith with two other guys in the market, two other brokers. They need to source borrowing, so this will filter through directly. It does not have to go via my desk to Hitish's desk. Hitish will source borrowing, and he will move it in the back to said client, or if this is not a client, to their prime brokers or their custodians, who will act as agents on their behalf. I think the more complex one, away from the monetization and the client relationship or facilitation side of things, is the derivative hedging. Now, this is managing risk from structured and derivative products. Now, in short, if a desk is sitting long or a bank is sitting long any derivative product, it means they will be short the underlying or the delta and have to secure borrow. Now, I've put some examples there. This is single stock options, OTC, any sort of OTC structure, any sort of structured products where we will source sizable borrow in advance. And when the structure is executed, lock that down. Equity linked notes, auto callables, warrants, normal index arb trade is where we will utilize or lock down borrow and effectively hedge these trades. But in short, those are the three main pillars, with the additional one, the fourth one being, as a trading desk yourselves, do you see opportunity in monetizing? That will be also assisted by the stock borrow desk. I think let's jump on to the next slide, Hitesh. Now, Hitesh has touched on a lot of this, but I still think it's worth chatting around this. The strategic importance of a stock lending desk, not just in a cash equity environment like you guys are all familiar with, but the broader complex. It balances markets, and what I mean by that is it gives you a clear indication of trends and thematic movements. Who tends to move first? The guys with the mandates that are able to short or short sell, but those will be the hedge funds. But away from that, also what is the market's view on said sectors, particular resources or whatever the case may be, because we could see it in structured products, derivative and overlay structures, and hedging strategies. Risk transfer, as I've touched on the last point, hedging strategies. It could be an efficient tool to manage, to transfer risk or to manage risk efficiently, and that filters into the next one, which is hedging. And hedging, not just the complex structures, i.e. structured products or OTC derivatives or option structures, but just a straightforward, your trading book or institutional clients' trading book sitting long or overweight banking exposure and needs to start trimming this. They can use this to short sell broader financial or industrials against it. Capital efficiency, that speaks for itself. Reduced inventory requirements is something that's utilized locally, but not to a massive extent. Similar to the balance sheet utilization, it could just be to loosen up cash where you will go short and generate cash, but you'll most likely run something against it. Benefit to the market speak for itself. I think it gives you depth, it gives you liquidity, and a lower point there, price discovery, which I think is probably one of the most key markers across equity markets across the world, is the ability to see which way the market tends to move and how this faster money and retail cohort move quite quickly. If you look at something like the US markets, I mean, the retail cohort is now, call it 40% of what trades in the States. And that the substantial number, and these are the guys that tend to move quite quickly, as you know, in terms of putting shorts on. And this doesn't just stretch to single stocks. This is short ETFs, and at some extent getting leverage on these products to short. And then, as I said, the ability to express negative views just ties into the broader benefit of the market, price discovery, and sort of the read through into the thematic piece, but it also improves execution capability. So in short, I think if you had to bullet point this up, it's to facilitate, it's to source, which means not severe price impacts, and hedge. If we look at the more complex structures. But what I want to point out as well is it is a very interesting metric to track. If you look at short interest, I referred to the South African market in particular, where we are running. It's no secret that the end consumer here has been struggling, and our retail stocks have been struggling for quite some time now. The way we track this is not just by ownership stats, of who's sitting along these positions, but also the short interest, which paints a far more accurate picture in terms of price swings or movements. Now, what I mean by that is, if you've got a stock that's under-owned with a large short interest on that, it takes a handful of buy tickets to rip the stock through and trigger short, or can I call it stop losses on the way up. Now, if you go and look at some of these retail stocks, it was very evident last week that 2 or 3 buy tickets ripped stock 6, 7, 8%, and it becomes a very key metric for us to track. I think let's leave it there, and we can touch on questions later on.
Cool. Thanks, Jess. And just in case you were wondering where we got all this information from to put this lovely slide together, the exchange will share the deck, but there are some touch points of where we saw some of this information to build the deck. So you can have a look and see from these websites, from the exchange themselves, from Pencom's publications, ASCO, BIS, Sazler's website as well, and Straight has information on securities lending. On ISLA's website, they've got a lot of information on how the product works, global standards. They've published papers netting opinions for different jurisdictions. Go and have a look. There's a lot of information out there. Alternatively, reach out to me. I'm glad you point you in the right direction. We'll try and help you. And Ugochi, that is us. Thank you so much.
Thank you so much, Hitesh and Jess. Thank you for that. Indeed, there's so many questions your way, but like I mentioned before, we will take them at the end after we've heard from Deji. Deji Aloko, who is the head of Investor Services Products in Stanbic IBTC Bank Limited. We'll go on riding on what Jess and Hitesh have spoken about to speak now about roles of security lending in liquidity provision. From the agent's perspective in Nigeria, bringing it home to you here in Nigeria and to see how it all applies. Deji, hi.
Hello, Gucci. Can you hear me very well?
I can hear you very well. Just
Thank you
waiting
so
on
much.
your slide to go on presenter mode.
Okay, it's there already. I can see the shares. I'm sharing my full screen. Yeah, maybe it's
Fantastic. We can
network.
see your screen. We can see your screen though.
Okay. I'm not sure why it's showing full screen mode here. I think I will maybe just start so that I won't waste time. And I usually like it when Hitesh and Jesse go before me because they put a very good background to what we're talking about now. I think I would start with one of the quotes that Hitesh mentioned, which is very key in what we're trying to do. He said, liquidity is a shared responsibility. And I would like to thank NGX for their commitment to the growth of this market. It is important to say that since 2012, the market making structure and framework had been around in Nigeria. I then asked myself, I also am part of the brokerage world now in custody. Why has this not been a huge thing, or why has there not been active take on in Nigeria? I guess indeed, securities lending, as Jess and Hitesh has mentioned, is not just something of the week, it's a critical part of every developed capital market in Nigeria. I would like to start by giving some statistics. The Group C, the C that mentioned, the Nigerian trades about $30 million per day average daily turnover. In contrast, I think in 2024 or 2025, if I got my details right, the South African markets trade about $1.2 billion on a daily basis. So if you look at that and compare the sizes of the economy, the size of the South African economy is about $427 billion. And then Nigeria is about $334 billion. That's the size of the GDP, if you nominal GDP. So you imagine the opportunity. So it's not a weakness. It is the opportunity that is inherent to the Nigerian economy. As we're growing our capital market to that basis. So if you're moving from $30 million on daily basis to $1.2 billion, it is the size of the opportunity. So you look at that side of the opportunity and how we've been leaving money off the table. Again, I will ask the brokers, if you're looking at last year and you chart the cost, at least even if you start with NGX 30, the kind of volatility you'd have seen in the market. If you chart the cost of, for example, Zenith Bank that Jesse mentioned, or maybe First Bank or any other stock that you see in the market, even in the consumer sector, you chart their cost upwards, you see the amount of volatility that is there. The number of volatility is also the number of missed opportunities that you may have to have sold, short selling, and also use securities lending to settle your position, especially if you have a strong conviction. What then we would ask ourselves is, why exactly are we in the brokerage market not doing that as equities brokerage? Another stat that I'd like to give to you before I go into my presentation proper is that from 2015, Stanbic IBTC started securities lending offering. Now, we started with equities because of, number one, the regulatory support we got from the NGX in tandem with the SEC, which has been very, very forward-looking. And so we started with equities and not even the fixed income market. And we also had to do a lot of advocacy regarding, taxes, reforms and recognition of securities lending in the tax laws. And since that time, I think the highest move that we've done in the equities market was a trade of 150 million naira, 150 million naira for the size of our market. In contrast, in 2024, we then got internal approval and started with fixed income market. So the fixed income market is on the other side, the banks and the other, and we also opened up international brokers. And in 1 year, we did a trade of about 25 billion naira. That's a contrast. So in 1 year, we started in 2024, and in that 1 year, the fixed income guys borrowed about 21 billion, about 25 billion in securities, in trading. What is the difference? It's just the difference in the security and then difference in the balance sheet size and the risk-taking appetite, and perhaps the expertise of the participants in different markets. These markets have traders, equities traders, fixed income traders, but the equities traders are the ones leaving money off the table. And that's why NGX is doing all of these things in tandem with Stanbic IBTC and Standard Bank to try to see. Indeed, Hitesh was in country last year to try to go around. We also advocated for pension funds to be included in securities lending, and regulatory push was there. PENCOM did it, and in the twilight of the Buhari years, the Business Facilitation Bill was put up, and pension fund assets were eligible for securities lending. Now, if you think about the size of the pension fund in Nigeria, the amount of the size of the asset management firms in Nigeria, you think about the amount of facilities and securities that are available to you. Even if you're going to start with just NGX 30, or if you're looking at market making, you're also taking some parts of the illiquid stocks. The opportunity size is massive. And I want us to leave here today and think about how much more we can do in the market, apart from the plain vanilla trading and the expertise we have, because of the size of the market, because of the opportunities, and because of the depth we can take the market to. So you're looking at this from an opportunity perspective, and a different market perspective, an enlightenment perspective, and a development perspective, because as participants in the market, what all of us want is a market that can rival any market and in the world. And as we're growing and Africa begins to take strategic stake in the economy, as we begin to see and ask ourselves, what role as equities brokers, what role as participants on the NGX do we want to use and do we want to take? And we want to be at the forefront, we want to be leading. And that's why we are here today. That said, we go right into that presentation. So the Nigerian market has demonstrated a very strong
DG, apologies for interrupting you, but unfortunately we can't really see the deck. So would you mind stop sharing, resharing, so that once you share again and go into the presenter mode, the slides will be a lot clearer. Because you've spoken so much in terms of Stanbic what has happened, and I'm sure the participants will like to see in depth into what is happening and how they can get involved. So if you share again.
Okay, let me try. Let me try again. I'm screen sharing again now. Can you see it?
Yes, we can see your screen. Then if you go into the presenter mode, if you click on perfect, it's working right now. Thank you.
Okay, it's working right now. All right, thank you. And so the Nigerian market has demonstrated a very strong run. And in that run, we now see market transactions in 2025 about 11.23 trillion. Domestic activities take about 78%, and the international is about 22%. It gives us a lot of leeway as to the kind of issues and kind of opportunities and income that can be made and revenue. But what has characterized and the issues that we have is the thin liquidity. So low volumes in some stocks, especially in securities lending. I'd mentioned that there were no short sellers that came to lend securities because Stanbic is the only active agent right now. I bet that if the market was active, we'd have more agents, we'd have a wider pool of securities and wider pool of participants from the lender side and borrower side. We also figured that the brokers have a very low appetite for risk. And perhaps that's driven by the level of expertise that the brokers have. So, which is why Hitesh and Jess are here to try to raise the expertise of the Nigerian market, the equities brokers, to see what more you can do with your books. The balance sheet and the capital base is also part of the challenges that we have, because part of the SEC rules is that any borrower that comes to meet us would have to have credit limits, and your credit limits depends on the methodology that your balance sheet, it will be a critical part of. So because we have brokers that have small balance sheet, it then means that the credit limit that we probably would have for you will be a small credit limit, and then that might not make the borrowing viable. So it does also mean that we'd have to have participants that have larger balance sheet, and then are able to take on some of those risks and skills. And the limited market making and short selling activities. So there's a difference. The market making opportunities are plenty. The short selling opportunities are plenty, but there are very, very limited activities going on. So for example, so if you look at securities lending Nigeria, we've looked at institutional holdings. Hitesh has touched on a number of these things. It then moves into the securities lending pool, then the market makers and borrowers can participate and higher trading, then we have a better capital market. I tried to put an illustration on it. As of September 2025, our pension asset was about 26.09 trillion. So if they are allowed to do up to 30% in each eligible securities that they can do. So if we're going to them en masse to say, if we had an active market in securities or on the exchange, then you can do 30% of that 26.09. That's about 7.8 trillion assets that can't be borrowed from them. So add 7.8 trillion to whatever it is, and that's just illustrated. We're not even talking about movement and liquidity, and then going back and forth. So add 7.8 trillion to what we have in the market right now. You see the amount of boost that we can have in daily trading activities. Remember that we're looking at 1.2 billion in South African average trading volume, comparing with Nigeria's 30 million average trading volume, and looking at the opportunity that we can see to move to that 1.2 billion. I imagine that if we have an average trading volume of up to 1.2 billion, then we can say, okay, to a certain extent, Nigeria can be a leading market in Nigeria, in Africa. So our pension funds are one of the largest pools of long-term domestic capitals in Africa, and it keeps growing because of our population, because of our size, because of the rules and supporting rules and regulations. And they often hold shares for extended periods. Most of the time they buy and hold, as a lot of shareholders in Nigeria want to do. Even HNIs, you can have clients at HNIs, you can speak with them, you can have them lend their securities, put it in the pool. And then we can use that as activities are generated to bring in participants that are currently out of the market. We're trying to encourage younger demography into the market. Sec lending, some of these activities, but allowing yourself to be a lending intermediary, because you can also be an intermediary. The NGX has provided for that. And there are additional low risk income. The lender makes money, you, the borrower, makes money if you're taking good risk and you're trading on convictions on the volatility and as your expertise builds. So what determines your borrowing capacity? I think I touched on it before. The regulatory capital adequacy is there. Your credit rating and financial strength is very important. Your historical settlement performance to a certain extent, then your risk management capability. We, as Stanbic IBTC and Standard Bank, we have very robust technological process in which we manage our collateral on a daily basis and margin to ensure that we give comfort to the lenders, and we also are efficient to process things to the borrowers at every point in time, and the liquid collateral available. Because I have a very short period, I'm just trying to, what my charge would be, please, as we leave this place today, go back to your strategy desk. Let's not just do asset management. Let's not just do wealth management. Let's not just do selling and buying. Let's not just wait for 3 quotes in the market and see and follow the trends. Remain convinced in your expertise as brokers. Try to see how we can bring our books together and make sure that we are getting to a place where our market will rival anyone else in the world. Thank you very much.
Thank you, Deji, for that. And going straight to the point in terms of how and what to do. Now you've heard everybody, you've heard them talk about market making, security lending, and all. Now let's see it. And that's where Kenneth O'Hare, the team lead for market operations, comes in for the Nigerian exchange. And he's going to walk you through the operational workflow and trading system, the roles of the security lending in liquidity provision as well. So, Kenneth, can you hear me, please?
Yes, Udochi.
Fantastic. Please go on.
Thank you. And good morning, everyone, and thanks for joining again. So we have heard from most of my colleagues and facilitators, especially in terms of regulations and selection of being a market maker. So because I know that I'm also speaking to most of the community of the brokers here, I know that the platform you're seeing on the screen is not new to you. But one thing is sure, that when you have been approved and gone through all the selective process by the NGX regulations, and then you've been allotted the securities they're going to make market on, then the application comes to us at the NGX. One of the first things we do is to go to the onboarding process. We have to, because we are not just a regular trader, so we have to create a special username and ID for you, wherein you can now log in to be able to see the features for you to be able to make a market on. And so when you have your login details and as a trader, and then you log in, one of the first things you have to do is to check your market maker obligations. If you go to the tables and then you go to the market maker's obligation, you can see here, as I logged in, first of all, I have to let you know that this is a text environment I'm using. And so most of the price you might see might not reflect the actual price in the real market. So you see the obligations here for you as a market maker. And so you cannot make market outside these securities that you have been allotted to make market on. Okay, so coming back to the market, so how do you do that? For instance, you've seen that I have Zen Bank, I have the NGS group in my positions as a market maker. So what I would do, you need to know that you have to start market making right from the pre-open sections. So you're allowed to make your two-way quote throughout the sessions of the market. That's to tell you some of the privileges you've been given as a market maker, from the pre-open to the pre-open imbalance, that's auction, to when you transit to continue trading section, and the pre-close and pre-close auctions, and then of course at the end of the market. Market are extended, so you have the ample time to be able to monitor and watch what you're doing all through the day. All you need to do is to just right click, as you can see here. You see on the trades here, trades happen because I queued in during the pre-open sections. And then you right click and then you can see your market maker's quotes. It will just come up quickly. You can see here. So you need to monitor to see both on the buy and the sell side. Of course, you're doing a two-way quote. You look at the prices. One of the excellence of the market maker is to narrow for the tighter spread, to narrow the spread. So you see, you don't need on the form here, you select the security, and then for our markets, this security belongs to the premium board. You have the buy and the sell. You have select the price, the best bid and best offer. So you see here, and then you put in your quantity you want to buy. Remember again that for the market maker, you don't need an account number to be able to make your quote. Again, you just click for this replacing existing order. That means if you have an order that's in existing, because market is already on the influx, market is always moving. If I put in a quote earlier on and then discover that it has changed, that the market dynamics have changed, you can also use this form to be able to replace that quote that you already made. So if I click here, you can see it has said it's been accepted. Quote accepted. You see here, you can see your quote here. It came into between this price here, and then the 109, and then and the 109 in between here, just to also see that it can close, the tighter spread here. So I've already put in my quote, and if I want to also, because the market is 10% bid and up, limit up, limit down. If I want to also put another quote, I also go here, put in. Select my quote. I can put in the price I want to for the buy side. Usually know that you select on the lowest price because the rule has been always to buy low and sell high. So if I come here and put in 116, let's try 116. Okay, and then I put in 116. And then I come to the sell side, I put in 141.50. Remember, I posted the base on the limits up, limits down, because I'm saying that it's not the quote here is not up to the extent of the 10%. So if I click here, can you see what it's saying? Because I'm not doing the cross for myself. So because I need to reflect the best bid on the market at a time. So you don't need to cross because those quotes are not really in the market, because the whole essence of you doing the quoting is to close the gaps between existing orders in the market. Okay, so if I go back again and I put in, from what I've seen again, 19, the price here 109. Okay, and then I put in again on the sell side, I put in 109.2. Okay, again, you put in your quantity you want to do. Then I click OK. The quotes have been accepted again. It's queued on the line. So you also look at, because I also have other baskets, other securities here. For instance, I have the Mansard or NGS group. Let's go for NGS group on the security here. So you have is only on full bid. So what I do, because being a market maker, I want to stimulate the market. I don't just want the market to be activities to be dull. So I want to stimulate these activities. I come back here and I put in my market quote. And then for the NGS, so you look at the price for the buy side, I put in 128, and then for the sell side, a little bit spread. I put in 128. Let's say 128.2. Okay, and then you close, put in your quantity you want to buy, and then okay, you go back. You see, I have been able to add that. Remember that even if I clean this place, when you begin to put all the quotes on in all the securities that are making market on, you need to be very careful to ensure that you monitor and see when those quotes are being filled. So one of the things you do is when you are doing that, you go to your tables again to see, and then you go to your table to see your net position at a time. Okay, because yeah, it has not matched. So I have to, you'll be watching on this place to see your net position at each time you're trading, to ensure that, each monitor which one has been filled. And then if there's any need and the market has moved to replace whichever orders you've included, you can do that as well. One of the areas you can also do is to ensure that if you can see here, can see view order book by order. It also helps you to be able to monitor each of these securities that are making market on. You put in, you can unlink so that you make it separate, so that you can monitor. For example, I'm doing NGS group. If I want to do for the Zenith Bank as well, I also go back there, and then I'll do my view and all the book, and then I can unlink them. I can unlink them such that it can also be a standalone, and that way to help me to be able to monitor each of these securities I'm making market on. You see, when market making is a whole lot of job for the day, you need to ensure that you are always monitoring whatever you're making put on, and ensuring to understand where the market is at any point in time. One other thing also is to ensure that you have the advantage to be able to cover your positions, to see that whatever thing, especially when you, for instance, that's the NGS group that I have done that has already been on full bid, and I'm putting in positions on the other side of the order, which is on the sell side. I need to make sure that I have positions to cover. I have securities to be able to cover those positions so that they can settle and I have my books clean. Most of our facilitators have almost spoken so well in terms of ensuring that settlement is done, ensure that within the size, the put size you have within your firm, so that you minimize the risk and ensure that you have your clean book. One other leverage that we have there is that you don't pay the NGF fees, commission, you don't pay the CSCS commission, you don't pay even the SEC commission. The only thing that you pay is, I think, it's stamp duty. If necessary as well, the trade alert as well. That's one of the charges you incur in the course of your transaction. So you need to leverage on that. And one of the things we're also working on to see that, as you see, when you, instead of you going back and forth to check your details and what you have done, we are also trying to ensure that we develop or we build on alert. Like you see the regular when a company has gained up to 5% or above, and then of course also that applies to if it's gaining as well, so that market maker will be able to see that alert, and then they know that their orders have been filled, and then they can take decisions as well to ensure that they do a lot of activities within the market. The whole essence of that is to stimulate the market and ensure that with the security lending, it will be a great advantage for the market makers to ensure that they have all the borrow those securities and be able to provide liquidity in any of those markets or securities that are making markets on. My call this morning is to tell us that indeed, if we really want to build this market together and take it to the height wherein we want it to be, we have to participate. The market control and NGS regulations, we are always here to support in case of you during your onboarding program and in your trading system when you're trading. If you have any issues, if they have any needs to call us to attention, we will be able to help you, to assist you. So in terms of this replacement, I know that most of us who are traders, we understand what trade amendment. That's exactly what this does as well. So when you're trading and put in your double whale put and the market has moved and you want to replace that particular port, you have this platform to be able to do that. You don't need any of the account, to begin to pull up accounts to fill those columns. All you needed to do is just put in your buy and sell, and then of course your quantity, and then select the actual security. And of course, if you want to do anything outside the security that has been allotted to you, the system won't allow you to do that because the algorithm has been inbuilt to sort that. You won't allow you, just like you cannot do more than 10% while they're trading as a regular trader. That has also been inbuilt here as part of the regulation to see that you do the right thing when you're trading. So on that note, I just have to say thank you, Ugochi. I'll hand it over to you if there are questions. Thank you.
Thank you so much, Kenneth, for that, taking us through and exactly what to do. I know that might be a lot for some people at this point in time, but we did warn you that today's training was going to be very practical and very intense, and that we're bringing quite a lot to ensure that it's beyond a webinar. It's more of an in-depth training. But of course, at the X Academy, the two-time award-winning X Academy, we provide such trainings working with Stanbic IBTC to make sure that you also keep the knowledge going and you're informed at all times. That said, let's hear from you. You've been listening to everybody. It's now time to hear from you. And one of the questions I have is, and they're directed to Temitope. Temitope, let's start from the beginning. When you spoke, a question came in asking, what is the quote size? Is it the minimum number of shares that a market maker can bid for high value stock, or what?
Thank you very much, Ugochi, and thank you for the question. Yes, the quote size is the minimum number of shares that should be quoted by market makers across the price band. I think I mentioned in my slide, and Fumbi also alluded to it, for shares that are regarded as highly priced, the quote size, minimum size is 40, for medium is 100, and for low is 500. So I think Kenneth as well alluded to it. So yes, indeed, it's the minimum number of shares according to the price band that a market maker must quote.
Great, great. So yeah, some of the questions have been answered in the answer session, but we'll still take some of them. And while we are on it, Temitope, there's another question. How much does technology contribute to Nigeria, to NGX market making program? And how would tech startups participate? The person asking has said that notices that there are 8 market makers are very developed asset management shops.
Thank you. Yes, technology is, I would say, very fundamental, even generally to trading activity in the market. So it's not just particular to market making, definitely market making because of the active participation that is required to quote prices and to be the market presence as well, being 75%. But regarding collaboration on how fintech companies can plug into this, I would say it's probably collaboration with the market makers to help them provide that technological capabilities to be able to participate in the market. And regarding the 8 market makers or the eligibility to participate as market makers, you need to be a trading license holder, and it's not just asset management companies. I would say you have to be a trading license holder of the exchange, and by extension, SEC licensed broker or dealer in the Nigerian market.
You tell me top. Now I'm going to I see a question which will lead me to bring in somebody who's going to speak after me, but he is the right person to answer this question, and he's no other than Mr. Abimbola Babalola, who is the head trading and products department for the NGX. Bablo, can you hear me, please? Fantastic. There's a question I think that we need your expertise in, and it's saying that what is currently the biggest practical barrier to effective market making on NGX? Availability of securities, cost of capital, regulation, technology, or investor participation. What specific action is NGX taking to address that barrier?
Yes, thank you very much, Ugochira, and good afternoon, good morning, all. I think the question actually identifies some of the constraints, but today you see that because when you are doing market making, you are committing part of your capital, which is the something to risk. So today, securities lending is one of the constraints, because if I come to the market and I'm doing market making, it means that I'm probably selling what I don't have. But because in our market, we don't do naked short selling, it means that you must have had a securities lending arrangement in place before you can even go ahead and do market making. And that is the aspect that we're trying to enrich, because if you have more securities and I can do my risk assessment and I fall within my risk limit, then I will be able to participate and take action as far as securities, market making and security lending is concerned. Thank you.
Thank you so much, Bablo. Well, we have 15 more minutes for the questions. I see that some of them have been answered. The question on the personnel requirement for the new regime, it wasn't clear, but I see that Fumbi has gone ahead in the answered section to break it down for you and for anybody else that's asking. But Fumbi, there's a question I will bring up for you, which says that when selecting a securities basket, like you mentioned, how does NGX determine the appropriate capital requirement for a market maker, and how often is that capital requirement reviewed? If the free float market capitalization or the liquidity of securities change, how often is it reviewed? Fumbi, are you here with me? Okay, I think I have lost Fumbi for a second. So once he comes back, we will take that. Hitesh, hi. You're here? Or Jesse, anyone can. Beautiful. I have a question for you, what is the difference between operations of margin loans in 2008 and operations of security lending in 2026?
No problem. I think I did reply onto the chat, but yeah, basically, if you look at what happened in 2008, the facilities weren't monitored, right? The excesses you were able to trade without monitoring. Yeah, and what we look at now is there's strict monitoring in place. You've got short selling regulations. You've got reporting to the regulators in terms of what's being shorted. So the visibility of what's short is there now. You know, I think in the US, they've learned lessons from coming out of what happened in GameStop with the over leveraging. You know, you'd think after 2008 we would have learned lessons in the US specifically, but it happened again. If you look at a stock like GameStop, where it was over leveraged, and with a market cap, it was over leveraged, I think 10x over its market cap, if I'm not mistaken. Sorry, I said to be corrected. But examples like that is, and that gives, if you look at securities lending, a bad light because it had nothing to do with securities lending. You know, it was the mechanisms and the monitoring that allowed for that to happen. And at the end of the day, we got shunned, we got blamed from a point of view. So we've definitely evolved across, like I say, if you look at the international associations that are getting together, and this is the reason for these associations, they work with regulators. We were recently in a call with the International Association, myself, and the Kenyan Capital Market Authorities, look with the World Bank's Capital Market Authority guys, looking at how do we get that market up and running? What needs to be put in place? What guardrails need to be put in place to drive it? So it's definitely a lot. The pictures, the world's much different. It's more governed, and there's more visibility at the moment.
Okay, Hitesh, I see that you have also answered that question that asked what specific lesson from those markets, which the markets are Brazil, India, US, UK, and South Africa, specific lesson that you believe Nigerian can implement immediately, and what is the biggest obstacle preventing us, Nigeria, from implementing that? I see that you've answered that. Do you want to just pick on
one? I can go for it. So I think I probably maybe answered the second part and maybe omitted the first part. But I think the biggest lessons you can see in these developed worlds is, and you've adopted it, so is looking at the standards, engaging with industry players to get to a point where you have a standard that is recognized across the world. We've got ISLA that publishes opinions on behalf of your country to provide guidance as well. So there's a lot of work that's been done in the background. Did you mention we touched on 2013? We've been working on this product, getting things aligned, getting it up to where it is today. And I think from now, what needs to happen is we've got all the tools now. We've got PFA that's there, is to maybe do like sort of a live sandbox exercise. We saw earlier in terms of how to do the market making, you know. Take in a few stocks, let's secure some positions that are there from an equities point of view, run it through an environment, see what that looks like and that it does from a price discovery, market making point of view, and let's look at the whole picture and see how that works. So maybe a pilot exercise with a few stocks from an agent and see how it goes.
Thank you, Hitesh, for that. Shola, I see that you've asked a question where you can find the requirements to become a market maker. That was spoken earlier. The slides will be sent out. You'll find all the details there. But better still, the link for the YouTube access, it's available and posted, so you can listen to it all over again at your spare time. So that has been detailed in there. Bablo, I will call you once again to answer this question from Tunde, who is asking, will the market maker not have advantage to manipulate the share price in the market? Mr. Bablo, are you there, please?
Thank you very much. So I think the primary responsibility of a market maker is actually to provide liquidity. But they're not going to provide this liquidity. They're going to do it at their own price because it costs them. So the concept or the idea of manipulating the market doesn't come into place, because if you listen, I mean, most of the speakers have, you know, the exchange will give them their responsibility. How often should they disclose their price? So again, the fact that they disclose price, they are looking at what the market, they are you know, providing liquidity to the market. So they are not necessarily the only person monopolizing or dominating the market, because other participants are there. So it's about pricing. So it doesn't give room. It doesn't give them any undue advantage, except that they perform their responsibility. And in terms of regulation, we have people, the exchange is constantly monitoring their activity, ensuring that they comply with the obligation that they have been assigned with. So again, like I said, the whole overall objective of this is they're providing liquidity, but not necessarily being given undue advantage that will not lead to them manipulating the market. Because fundamentally, the primary responsibility of the exchange is to ensure that no individual or a group of individuals does have an edge to manipulate the market, but they have the responsibility to provide liquidity to the market. And that is why you see some of the criteria is how often are you in the market? What is the quality of quotes you are providing? They are participating and play, against the market. So the concept or the idea of day manipulating does not necessarily arise. Thank you.
Thank you, Pablo, for that explanation. Temitope Ali has asked, what is the state of derivatives market in Nigeria? Even though that's not part of what we're saying, but of course, every time we speak at the NGS, we provide more information that's asked. So right now, Ali is asking you, what is the state of the derivatives market in Nigeria?
Thank you very much, Ugochi. I would say the derivatives market is currently in its nascent stage. The NGX derivatives market currently have 4 index futures contract currently being traded, and we are looking to launch a single stock futures contract imminently, and this is also going to support, I would say, providing liquidity and helping market makers also provide that liquidity in the market where they can hedge their position and provide inventory flexibility for them if there is a functioning derivatives market and supporting their market making activity. Thank you very much.
Thank you for giving that explanation. And Ali, I hope that covers it for you. Kenneth, if I can call you in, Timilehi is asking a question based on what you have presented. And it's saying, can market makers connect to the Extreme via API or web sockets? Or do they need to have logins to the platform? And it's also saying, are the CLOBs for each security on the NGX publicly available for people to see the depth and spreads and volumes? Would you want me to repeat them all over again?
Yes, Ugochi, please.
Okay, so the first question is, can market makers connect to the Extreme via the API or WebSocket, or do they need to have logins to the platform?
For us, they have to log in through the platform as a market maker. Whatever API they're going to use, that has to also be vetted by the technology to see that they are up to the standard, wherein there'll be proof that they will not be, have other risk that might cascade by virtue of that. But we strongly advise that they will use that the login details are provided for them.
Fantastic. So the next part is, are the CLOBs for each security on the NGX publicly available for people to see the depth and spreads and volumes?
Oh, yes. Yeah, for market makers, they will see obviously the date of the order book, to see that date. Depending on the section of the market, usually during the pre-open sections, you don't see the date of the market. But when we transit to contingent trading, so obviously you will see all the date of the market to be able to know what to do at that point in time. Yes.
Thank you. Thank you. Temilehi, I hope that answers your question. Deji, Temilehi is also asking, Deji, are you here, please? Temilehi is also asking, can a market maker who is borrowing locates from lenders also decide to lend some of their inventory as well? Okay, please go on. I'll ask second part when you're done.
Okay, so we don't put it on the site right now, but we have regular advertisements of the assets that are available for lending. So as soon as you're signed on, as a client, as a borrowing client, you get out of this. And you can also come from the demand side also. If you have a particular security you're interested in, you can get in touch and we will check with the pool of lenders if they're available and then they're able to match that.
So it's also asking, are there live dashboards able to monitor your positions, margin calls, etc.?
Yes, we do have from our own end margin technology and monitoring technology. So we monitor that and give reports on a daily basis to the borrower to see this is where your margins are at the moment. So if there are needs for margin calls, we would know on the side and then when we call on to you to top up. You also know whether you have excess margins at that time. Indeed, our South African office, that's Hitesh's office, are the ones that manage. So we have robust technology to manage the collateral. So you might not see live from your own end, but we're seeing live and we're monitoring on a daily basis. But the borrower gets reports on a daily basis.
Your video is not on, in case you didn't know that, but Kwame is also asking and saying, when will Stanbic connect her security lending platform with agent lender brokers, OMS trading platforms? Would that be you or Hitesh?
I think it will be made any Hitesh. I will have to give it to Hitesh. It will be perhaps maybe a going forward kind of this discussion as market evolves and as need be. At every point in time, as technology evolves, I think at a point we have to see how we can connect and people can see things from their trading platforms. Well, Hitesh, are there plans, right now?
Yeah, so right now there's no plans to integrate at the moment. So if you look at in the current South African environment itself, when we're able to publish availability in a position to provide availability, market availability, that normally gets ingested, so it gets sent out to the clients, and they would ingest that into their systems, and it will come there. So we have various clients. We send out, for instance, in South Africa, we'll send out a market availability for SA stocks daily, and that gets ingested into their systems. There are marketplaces we're looking at in the next year or so, NGT, Purim, and so forth. These are marketplaces, GMLX from a bond point of view, where you're able to post in availability from there, and we're able to fetch. If you are looking for some sort of integration directly into your platforms, that's something we have to look at.
Thank you, Hitesh and Deji, for that. Bablo, there is a question has been asked in different ways, but I'll try to merge it. And it is saying that presently, they're now aware of any broking house on NGX that provides security lending to retail individual investors, that most times they're provided to big corporate entities only. So the person is asking, unfortunately I say anonymous, but the person is asking if there is, please let them know.
So thank you very much. I think the way the program is designed is if you think you have securities that you want to make available for lending, so you can approach your stockbroker, then your stockbroker will introduce you to a securities lending agent and take you through the process of, you being onboarded and also following the process. So there's a process in place, but I would say approach your stockbroker because it means that that security, there are processes involved. If I say I'm making these securities available for lending, that means that that security through an OTC method will be moved from your stockbroking position to that of a security lending agent, and it will be made available, and the rental income and all the associated benefits that are supposed to come from that process will also come to you. So my advice is please approach your stockbroker and tell them you want to participate in securities lending program. Thank you.
Thank you, Bablo, for confirming that it's indeed you can do that through your stockbroker. But before you go off, there's a question for Aremu, and that will be our last question for today. And it's saying that what license do you need to operate as a market maker? I know that has been said earlier, but please do help out. Is it a broker, dealer, or broker?
So thank you very much, Ugochi. I think the license you will need is that of a broker dealer. But in addition to that, we will also now, because market making is an additional function to your broker dealer responsibility. So it involves you having some certain things in terms of, capital, in terms of what you're supposed to provide in technology, how you're able to manage this. So we have a requirement for that, but the base license is that you must be a broker dealer.
Thank you so much, Pablo, for giving that confirmation and clarity. Aremu, I hope that answers your question. And with that, we've come to the end of today's training. You do agree with me of everything I spoke about it, that it was, first of all, going to be just one day. Two, that you're going to have experts speaking through all. Believe me, it is a privilege to be able to host 4 or 5 speakers at the same time, providing you with such information. You will not get it anywhere else other than the NGX, and of course, in partnership with Stanbic IBTC. And that's where you have the X Academy standing in to always provide that knowledge and build your capability in every way. So with that said, my name is Ugochi Obi, and yes, I oversee the affairs of the 2-time award-winning X Academy. That said, thank you for tuning in. But before you go, don't just go off yet. I'd like to call on the person that you've been hearing speak to give you a bit more on what to do, the next steps, and of course, tell you what to do after you've heard everything so far. And that will be Mr. Abimbola Babalola, fondly known as Bablo, the head trading and products department of the Nigerian Exchange Limited.
Yes, thank you very much, Ugochi. I think I'm being mandated to give the closing remarks. But I think before I even go to that, what you will see us do in terms of next action is to start engaging the licensed market makers, sit down with them, sit down with their board to make sure that all the necessary infrastructure and tools and technology that they need to put in place are in place, and also to continue with their education so that participants can actually make use of this program to maximize their return as far as investing in the equities market is concerned. So let me go to the closing remarks. I said, good afternoon, ladies and gentlemen, trading license holders, facilitators, and participants, and my colleagues. Thank you for your active participation in today's session on market making and securities lending in the Nigerian equity market. I would like to particularly appreciate our facilitators from Standard Bank Group and Stanbic IBTC, as well as my colleagues from NGX Regulation Limited and NGX Limited for the practical insight shared across the different sessions. Today's discussions have reinforced an important point that effective market making requires more than just obligation to provide two-way quotes. It requires an enabling ecosystem that supports liquidity providers with appropriate market infrastructure, access to inventory, efficient operational processes, sound risk management, and a clear regulatory framework. The discussion on securities lending are particularly important in this regard because a functional securities lending market provides market makers with greater flexibility to manage inventory, respond to one-sided order flows, and maintain liquidity under different market conditions. As we will seek to deepen liquidity across Nigerian equity market, strengthening the linkage between market making and securities lending will therefore remain an important area of focus. At NGX, we recognize that the effectiveness of a market making program and securities lending framework will ultimately depend on the availability of participants to operate in a commercial and a sustainable form. We will therefore continue to engage market makers, trading license holders, securities lending agents, and other relevant stakeholders to identify and address operational, regulatory, and market structure constraints affecting participation. This engagement is not intended to be a one-off, but part of a broader effort to strengthen the market making and securities lending ecosystem and encourage more consistent liquidity provision across asset classes. We encourage all market makers and trading license holders to remain actively engaged with the exchange and to continue sharing practical recommendations that can support the development of a more liquid, efficient, and a resilient market. Once again, on behalf of the Nigerian Exchange Limited, I would like to thank all the facilitators and participants for their time and contribution. We look forward to continue with the conversation and, more importantly, translating today's discussion into practical improvement in the market. Thank you very much. Do have a productive day. Thank you.
Thank you so much, Mr. Bablo. And again, just like he has thanked everybody, I also like to thank the CEO, Mr. Jude Chiamaka, who has been with us all through, ensuring that the knowledge is passed on. Again, thank you to Jesse and Hitesh, also Deji, Fumbi, Temitope, and Kenneth for, again, passing on the knowledge and making sure that it's broken down so that everybody understands. But most importantly, thank you for coming up today and making a difference, because from what you've heard, you're going to action. And with that, we will see the difference or the impact in the coming weeks to come. With that, I'd like to say thank you. Thank you for coming in. We're always available at the NGX to support you in every way we can, in the academy to support you everywhere we can. Have a lovely day and thank you. Bye.